Michael Burry is back on Twitter explaining why the recent market rally won't last. The S&P 500 is now up 15% from its October low, and the Nasdaq of tech-related companies is up 16% in less than a month. And in a series of cryptic tweets that Michael Burry this time promised he wouldn't delete, he essentially said that he already deleted them. In this latest batch of deleted tweets, he essentially told us about why he sees the stock market continuing to fall in 2023. And it has a lot to do with the Federal Reserve and the FOMC meeting that happened last week. So today, I'm going to be breaking down Michael Burry's latest deleted tweets and of course, what it means for the average investor today. Just before we get into that, today's video is sponsored by NordVPN. Just the other day, I was trying to watch Breaking Bad and I realized that it's not on the Australian Netflix, but it's on Stan, which is arguably the worst streaming service of all time. Luckily for me, I don't live under a rock, so instead of paying for yet another streaming service, I simply used NordVPN's one-click connect to route my connection through the United States, where Breaking Bad is on Netflix. Seriously, regardless of which streaming services you use, most media companies have different content deals in different countries and different regions, so if you're not using a VPN, then you're essentially missing out on the complete content library. NordVPN is the fastest VPN out there for protecting your identity online, and you don't have to be a techie to understand how to set it up. It's literally one click to access more than 5,300 servers across 60 countries. Also, if you're traveling and using free Wi-Fi points like the ones at the airport, then it's really important that you use a VPN to protect yourself against unsafe networks, which can essentially see your browsing history and steal sensitive information such as passwords and credit card information. Get a 2-year plan with a bonus gift to commemorate NordVPN's 11th birthday for a limited time only using my link in the description. It's risk-free with Nord's 30-day money-back guarantee, and don't forget to use my coupon code Hamish as well. Link and everything is down in the description below. The most recent tweet by Michael Burry was posted just last week where he said, sell. And since this tweet was made right before the FOMC meeting, many people misinterpreted this tweet as a signal for the meeting specifically. And I know this because all of the comments below his original tweet were just filled with people who I apparently have decided to sell their entire portfolios before Jerome Powell stood up and spoke through the microphone. And then on top of that, there was all the smug comments from people after the meeting saying that Michael Burry was wrong because the market surged after the meeting had ended. Both of those groups of people are completely wrong about what Michael Burry actually meant, and the truth of what he meant is actually buried within part of that FOMC meeting by the Federal Reserve. FOMC stands for the Federal Open Market Committee and consists of 12 members who meet 8 times a year to review the economic and financial conditions to ultimately make a choice about monetary policy. And the part that most people care about is seeing what the Federal Reserve is going to do with their federal funds interest rate. Are they going to increase it, keep it the same, or lower it? Because what they decide to do with that has ripple effects across the economy and financial markets. At last week's meeting, the Fed raised interest rates by 0.25% to bring the federal funds rate to a range of 4.5 to 4.75%. And this marks the 8th rate hike since March last year and the highest level since October 2007. Jerome Powell, head of the Federal Reserve, stated that the continued rate hikes represent their commitment to ensuring that inflation gets back down to 2%. Currently, annual inflation still sits at 6.5% and has been coming down, but more data would be needed for the Fed to be confident that this reflects a permanent decline. And this is because the headline inflation figures aren't really telling us the whole story. On a month-over-month basis, overall US inflation was actually negative 0.1% in December, and you can see that since July, the rate of monthly inflation has actually been incredibly low. But when we look at the individual line items that make up the headline inflation figure, the story is a little bit different. The slowdown in inflation is almost entirely due to huge declines in energy, such as gasoline declining by 9.4% in December alone. This trend mostly represents the easing of supply-side bottlenecks in the energy sector that were initially caused by the end of the pandemic and the war in Ukraine. But inflation in other areas isn't easing as quickly, with core inflation still rising 0.3%. 0.3% might not seem like a lot, and relative to the other recent months, it's not a lot. 0.3% on a compounded basis over 12 months represents annual inflation of about 3.7%. So why is the Federal Reserve still being so aggressive with their rate hikes?
Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched.
The biggest concern right now for the Fed is that inflation remains elevated for a sustained period of time and consumers begin to expect high inflation permanently. This is bad because if consumers come to get used to high inflation and used to the expectation that prices are going to continue to rise a reasonable amount in the near term, then they'll start buying goods that they need over the next couple of years today, and that's going to add more demand demand and ultimately fuel more inflation. And there's really no reason for the Fed not to keep raising rates given that the labor market is extremely hot still.
Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers.
But despite Jerome Powell's stern words, the market was still pretty happy with the 0.25% rate hike, with the market rising 3% during the press conference. And a lot of people were giving Michael Burry a hard time after this, saying that his tweet was wrong or his prediction was wrong and that the market actually rallied after the Fed meeting. But those people completely missed the actual meaning behind his tweet, and there was actually something said by Jerome Powell during the meeting that actually confirms his general argument for 2023. There are two other tweets that Burry made and deleted that share some context for the confusing sell tweet. The first was posted 2 weeks ago and is a chart where he indicates that we might be in a similar position to late 2001. For comparison, the S&P 500 declined 31% from August 2000 to September 2001. Then the market increased 10% for 6 months before falling another 29% over 6 months. And only then, after the market had been declining for almost 3 years, did a bull market begin again. So far today, the S&P 500 first declined 25% from December 2021 to October 2022, and then since then it's increased 16% in 4 months. In a tweet from earlier in January, he gave even more context to why this rally won't last. He said, "Inflation has peaked, but it's not the last peak in the cycle. We're likely to see CPI lower, possibly negative in the second half of 2023, and the US in recession by any definition. The Fed will cut and the government will stimulate, and we will have another inflation spike. It's not hard." Burry believes that the extremely fast interest rate increases by the Fed will have a delayed effect on the economy that will cause a recession later this year. And we may have actually already seen the start of this. During the Fed meeting, Powell stated that the US is seeing a slowdown in economic growth caused by interest rate hikes.
Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
So far, the slowdown hasn't been overly negative for the economy, and many people still believe that we're going to be able to have a soft landing. That's just a fancy way of saying that the interest rate increases will be just enough to get inflation under control, but not too much to tip the US into recession. If Burry is right and there is a substantial delay in the effect of interest rate hikes, we may only be seeing the beginning of an economic slowdown. And if we go back to the other tweet, we can understand a bit more about how this could directly impact the stock market. And right in the middle where Burry circled we might be today was the part of the decline where speculative stocks had collapsed, but large caps, which made up most of the S&P 500's weighting, still had a way to fall. If this sounds familiar, I did mention this in my previous Michael Burry video from just a couple of days ago, but I wanted to dive into it a little bit more and actually demonstrate this point with the large S&P 500 companies today. Firstly, we've certainly experienced the first half of what happened in 2000 during the internet bubble, which was the speculative and unprofitable companies, they were internet companies at the time, have collapsed, and today the same thing has happened. And we can see this astounding decline in unprofitable gambly stocks by looking at the recent performance of ARK Innovation Fund. The fund managed by Cathie Woods is filled with companies focused on disruptive technologies, with the largest holdings including Tesla, Zoom, Block, and Coinbase. During 2020, when the Federal Reserve was pumping free money into the markets, this ARK fund did extremely well, up almost 200% in 2020. But then, starting in February 2021, the hot air began to escape, with the fund now down 80% from its peak, bringing its return back below the S&P 500 since its inception in 2014. But while the tech bubble of our generation seems to have popped, Burry believes that large cap companies still have pretty rosy future expectations. To be specific, I took some of the largest companies in the S&P 500 and ran discounted cash flows to see if we bought those stocks today, what kind of growth would they need to achieve in order to justify those stock prices or the price that we pay today. And I'm doing all of this using a discount rate or a required rate of return of 10%. Apple is the largest company in the S&P 500, and if we're trying to target a long-term return of 10%, then buying the stock today implies that they'll grow earnings at about 17% per year over the next 5 years. Microsoft would need to grow at 15% per year. Amazon, the third largest company, would need to grow earnings at 55% per year from their trailing 12 months earnings figure. Alphabet is the lowest out of all of them at 8% per year. And then we have Tesla, whose stock has already fallen 50%, would need to grow earnings at 30% per year. Now, I'm not even making assumptions about these companies. I haven't valued all of these companies. I've valued some of them, but for a few of them, I have no idea what is reasonable for the earnings growth of these companies. I'm simply pointing out what the market currently expects out of these businesses, given where interest rates are, where market premiums are, and where stock prices are. The point isn't here that these companies are definitely overvalued or something like that. I'm just pointing out that the market is clearly still very bullish about the largest companies in the S&P 500, even after the 2022 that we had. But while Burry is tweeting sell, it probably isn't in your best interest to take that advice for your own portfolio. And the reason for that is that we ultimately don't know how the stock market is going to react to whatever happens in the economy. So even if we knew what was going to happen in the economy, we wouldn't be able to trade or time the market in the short term, because the market could react in any way. And that might sound familiar. It's because I had the same point to make in a video at the start of the year when talking about biggest investing mistakes that you could be making this year. I actually used one of Burry's tweets that I spoke about today as an example in that video to demonstrate a macroeconomic prediction that might be interesting to follow and learn about, but that you should certainly not be using to make trades or investment decisions. I like listening to Burry. He's a very smart guy, but at the end of the day, I'm making investment decisions based on the individual stock or what equity or asset that's in front of me. And that's how Michael Burry invests too. Just last week, we spoke about Burry's fund letters where he explicitly told us to focus on individual opportunities. In fact, it's how he made 70% while the S&P 500 was down in the early 2000s. And a really good example from my own portfolio over the last 12 months is what I did and how I managed my Netflix investment. The S&P 500 over the past 12 months, is down about 8%, whereas I'm up 15%. And the main reason for that is because I made Netflix my largest position in May of 2022. I knew at the time that the macro environment didn't look great. I knew that interest rates could keep going up and maybe inflation would keep getting worse. I knew things could possibly get worse in the short term, but I didn't care because on an individual basis, the stock's price was very good. It looked like a good investment. In the case of Netflix, the stock came down first from an outrageously expensive stock, but then continued to fall far below its value based on short-term fears around subscriber growth. And once the fears subsided, the stock essentially reversed the entire 50% decline, resulting in a 100% gain on the way back up. So I essentially got paid for having a better understanding than the market on the subscriber problem with Netflix, or maybe phrased better, the lack of a subscriber problem. And now that there's much more broad consensus confidence in Netflix, that opportunity is gone. The point here, of course, isn't about Netflix stock specifically, but about the idea that these opportunities happen in the markets. They're very real. People overreact. As a broad market, they overreact to negative news or positive news, and that gives you opportunities if you understand the businesses you're investing in, not very often, but occasionally, to seek out these kinds of opportunities. And that's exactly what Michael Burry does, so that he is able to do extremely well, even if the overall market is in decline. Remember to check out NordVPN by using my link and coupon code in the description below for the best deal, and subscribe to the YouTube channel if you haven't already.